My name is Andrew Flattery. I am the owner of Simple Wealth Planning, a registered investment advisor. All opinions expressed by me and my guests are solely our own opinions and do not reflect the opinions of Simple Wealth Planning. This podcast is for informational and entertainment purposes only and should not be relied upon as investment tax or legal advice. Clients of Simple Wealth Planning may maintain positions in Bitcoin and the securities discussed in this podcast. The pros not understanding Bitcoin is a good thing for us. Quote, amateur investors have always had advantages over professionals. They can invest for the long run and ignore the short term since they can't get fired for underperformance and don't have clients who give them money or take it away at the worst time, end quote. That is a quote by Jason Zweig of the Wall Street Journal. Last year, I bumped into an advisor friend, a highly intelligent professional guy that I respect who serves many satisfied clients, and he asked me about my interest in Bitcoin. I shared a few pithy thoughts. Despite what you might think of listening to this podcast here, I actually am usually quite reluctant to be a promoter on this topic in public. The advisor's response was friendly and not atypical. He said something like, "That's great, but I think the real game changer is the different use cases of blockchain technology." That's what he said. Perhaps he was being polite, wanted to contribute something to the conversation, but I immediately understood that he didn't get it. And so if you think about it, the uses for blockchain technology, it was a fashionable, smart-sounding talking point. I recall hearing quite a lot in like the 2015, 2017 era. I may even have said that myself at one point in time, full disclosure. But since then, it's been proven to me to not be true, although you still hear it said on occasion as I did with my advisor friend. So for those of us deep down the rabbit hole, the case for holding Bitcoin is that it is a long-term store of value. It's better money that can preserve purchasing power over time and space. This simple thesis, although intuitive and the most proven of all use cases in crypto, is still niche. Outside of, you might say, a very loud minority, of course. It is particularly niche amongst those select portfolio managers and investment committees who control a majority of financial assets. I am not picking on my advisor friend who is focused on different use cases of blockchain technology because he's not alone, and I'm sort of glad to see it. While Bitcoin is in common parlance now in market commentary, politics, and internet culture, few understand what could be an idea hiding in plain sight. So this is good news for us, as herein lies the opportunity. Individuals have won out over institutions during the dramatic rise of Bitcoin over the last 15 years, while the proverbial yuppie elite were dismissive, thanks to Croesus, Jesse Myers, for that moniker. The profits from holding have accrued instead to regular Joes, Anons, previously second/third tier venture capital types. And here I'm referring to, well, it's a veiled shot at the Winklevoss twins and others who are no longer third tier, by the way, but they were once upon a time. My brother Tim gave me this book called Bitcoin Billionaires by Ben Mesrick, and it is an entertaining read on that topic and worth picking up if you're curious about it. So it was individuals who were able to front run BlackRock and Fidelity prior to the approval of the spot ETFs earlier this year. Although I own a firm and invest on behalf of my clients, and therefore more constrained, I have always tried to emulate intelligent individual investors rather than large institutions. That's the model here. You've heard me talk in this podcast in the past about Joe Rosenfeld, who was on the endowment committee at Cornell College in Iowa back in the 60s, 70s, and 80s, turned this little liberal arts college into one of the largest endowments in the country. That's kind of the idea. He was acting more like an individual, despite the fact that he was working with an institution. This is why we don't focus on short-term results. We don't merely allocate to the total market portfolio. We have opinions. We eschew the scandal of quote unquote indexing nihilism. This is the reason why we were able to allocate to Bitcoin, starting at my firm in March of 2021, and then to add to our position in May of 2022, for example. I like fundamental equity investors a lot, but they have a hard time with Bitcoin. There are no physical assets. There are no physical assets, no cash flows, no business. And so this is why I enjoyed a recent interview with Eric Semler, who is a former hedge fund manager turned CEO of a publicly traded company. The interview was with Marty Bent on the TFCT podcast. And Semler has implemented a Bitcoin treasury strategy at Semler Scientific. He followed the Michael Saylor playbook just this year, and he represents the trickle of large institutions that are slowly catching up to the individuals that have already adopted this strategy. His response to professional equity investors that are scratching their heads at this because, for example, there's no business, no cash flows, no assets, etc. He's saying that this mindset is what provides the opportunity. So here is Eric Semler.
I think Bitcoin has to be even more confusing for this type of investors sort of stuck in their ways because it's not a company, it's not a business, it's not producing cash flows. It's this scarce digital asset that runs on a distributed peer-to-peer protocol. And so looking at this, and that's funny, I was at a dinner a couple of weeks ago in Austin and ran into a Bitcoin naysayer, and that was like his biggest thing. He's like, I like things that produce cash flows and can spit out dividends, and Bitcoin doesn't do any of that. It doesn't have any intrinsic value, and therefore I'm not going to invest in it. And so inputting this digital asset into the world and positioning it as a once in a lifetime asymmetric opportunity seems completely foreign to a lot of these types.
Yeah. And I think that's great. I mean, I think we need more people to think that way, like your friend, because that's how we make more money in this concept, I believe, or how it succeeds. You know, I think that you need that friction to continue. And I think most of those people will come around once they really understand what Bitcoin is.
So Eric Semler of Semler Scientific responding to Marty Bent there. In other words, if everyone agreed with us, there would be little opportunity left. So Semler also gave his explanation on why institutional inertia on boards of directors, for example, contributes to this friction. Here he is again.
What I've learned from that, serving on public company boards, is that most boards, in my opinion, are filled with directors who are looking to just collect a paycheck every quarter. They don't tend to own a lot of the company stock that they're on the board of. It's not something where they have a lot of skin in the game. They tend to be older people who are retired and almost doing this just as a source of income and don't feel the pain or the incentives maybe that we would feel as shareholders. So I think that board members generally are risk averse. You know, they're not looking to take a gamble on something like Bitcoin. They see it as a gamble. You know, I don't, but they see it as, you know, potentially a threat to their paycheck as a board member. And it's very difficult for company boards to come around.
Even after the successful Bitcoin ETF launch, which opened the gates for anyone with a brokerage account to invest, removing a lot of barriers to entry, there's still a sense that most pros are not on board. I've described it as from my vantage point, kind of the barbell thing. So on one end of the barbell, you have the largest firms in the world, BlackRock, Fidelity, they are involved. Notably, Vanguard is not, but BlackRock and Fidelity have plenty of money to throw around. They have plenty of lawyers to deal with the compliance headache that this is. And they probably need to have a position. They need to have a stake if this is going to become a major part of the future financial system. So that's one end of the barbell. And on the other end of the barbell, you have kind of the cowboys. So these small registered investment advisor firms like myself who are interested in this. Everyone in the middle, from my vantage point, is not involved, with the exceptions that everyone knows about. The Wisconsin Public Pension Fund, things of that nature, which I think Semler is going to mention here in the next quote that I'm going to play for you. So anyway, the barrier to entry, at least with regards to the ETF, is removed. And so this does beg the question, why is this? Where are the institutions at this point? Semler points out that we are still left with the classic principal agent problem. The interests of those managing the investor's money are not necessarily aligned with the investor. Let me put it this way. Why would a successful portfolio manager allocate to Bitcoin, even if it was a good idea, when it could tarnish his reputation, affect his paycheck, even get him fired? This sounds harsh, but incentives matter. You might have heard the name James Burnham. He used even stronger language over 80 years ago in his provocative book, The Managerial Revolution. Burnham said, quote, "Managerial activity tends to become inbred and self-justifying. The enterprise comes to be thought of as existing for the sake of its managers, not the managers for the enterprise," end quote.
And that's why we were able to make this decision, and why a lot of companies won't be able to do it, because they can't get that type of consensus on their board, and their board members don't want to take what they perceive as that type of risk. They see it as a very risky kind of, I think, in some cases, probably, just too outside the box for them to make that bold a decision. And they'd rather just maintain the status quo. And so that's why we did it. That's why we were able to do it, and maybe why it's not happening as fast as it should. You would think that more companies with lots of cash on their balance sheet, big and small, would turn to owning some Bitcoin, just the way that Wisconsin Pension Fund is buying Bitcoin, or so many other institutions are buying it now with the ETFs. You would think that there would be more announcements. It's surprising there hasn't been, but maybe we were able to be early because our board has so much skin in the game.
Now, one response to this could be taking the status quo is perfectly appropriate in some cases. So being contrarian for contrarian's sake is foolish. It's the other side of the same coin. The point is that the status quo is often chosen for spineless reasons, like saving face or guarding a paycheck. Because I work with families with long-term outlooks, low time preference, if you will, as in many years, decades even, we have the opportunity to dream about results that are greater than the status quo. So we can choose to be slightly different, which is a necessity for outsized returns. Ian Castle, who I like, he's an investor on Twitter. He put it this way, quote, "Alpha is generated by being just a little bit different in a disciplined and thoughtful way." Granted, being an independent thinker, avoiding some of the perils of institutional managerial thinking does not mean that we are correct. The status quo exists for a reason. After all, Bitcoin may offer an attractive risk-reward opportunity, but it's no guarantee. Allocating into the asset gives us a chance that others who have not done the work will miss out on. For better or for worse, it means that there still might be an edge to be had. An edge, that's something that we've been told is only available to a select few, if to any at all. Complacency, ignorance, and inertia, especially amongst those who represent the largest pools of capital, present opportunities for us as individuals. There is a Peter Lynch adage. Lynch said, quote, "You don't have to invest like a big bureaucratic institution. If you choose to invest like one, then you're doomed to perform like one." The pros collectively don't yet understand Bitcoin, but that is changing. So, so we've got, I mentioned BlackRock and Fidelity. So notably BlackRock's Larry Fink and JP Morgan's Jamie Dimon have recently changed their tune. So, both of these notable finance figures, have been sort of anti-Bitcoin over the years. They've done a 180. They've changed their tune. They sound more like Flattery here every day. And we got to talk about Trump. So I am releasing this episode on Saturday, July 27th. And my understanding is Donald J. Trump is going to be speaking at the Bitcoin conference in Nashville this afternoon. I think it's like 2:00 Central that he's going to be addressing the largest conference in Bitcoin. So that's pretty substantial. Here is what Trump had to say about Bitcoin earlier this summer.
I will ensure that the future of crypto and the future of Bitcoin will be made in the USA, not driven overseas. I will support the right to self-custody to the nation's 50 million crypto holders. I say this with your vote. I will keep Elizabeth Warren and her goons away from your Bitcoin. And I will never allow the creation of a central bank digital currency.
So I haven't followed Trump's entire journey on this. My recollection was I think he was like Bitcoin skeptical in the past, if I recall, but I don't really remember. In any case, it is surreal, to say the least, to hear him do a 180 and make appeals to the Bitcoin community. I think probably recognizing his base here, although, it's not just his base. A lot of people own Bitcoin that aren't going to be voting for Donald Trump, but he's indicating that he at least now has people in his camp that get it. My understanding is, the vice president nominee, JD Vance, is a Bitcoiner, and I think he's listening to Vivek Ramaswamy, who has been an advocate for Bitcoin as well. So that's really interesting, and I think it's a big deal that he's speaking at this conference. So I fully recognize that in many ways it does look like the institutions are here. What did I just say? BlackRock, Fidelity, JP Morgan, and then of course the potential future president are talking about this. It's now a campaign issue. I totally get that. But what I'm saying is the monsoon has not happened yet. It hasn't come. The monsoon has not rained down on traditional finance yet. It's some folks at the very top, and then it's some of the cowboys here at the very bottom. Everyone in the middle is not there yet. Edward Jones is not there yet. If you will, the local broker around the corner. And that is my point here. So that's a good thing. That's our opportunity, and that will change. So our opportunity will not be here forever, I imagine. But looking ahead with the gradual increase in the number of long-term Bitcoin holders, the coalescing of more buyers of last resort. That is I think it's a Pierre Richard phrase, and new price floors being established every boom bust cycle. We can continue to validate the thesis playing out. And if this happens with the finite supply intact, the price should increase over time. And along the way, I suspect others will come around to Bitcoin at their own pace. All right, this podcast has been based on a letter that I wrote to clients of my firm here in July. If you have an interest in checking that out, I will share the link to that in the description to this episode. And with that, I will leave it there. We will see you next time.